you for joining us today to learn about the Pavilion Resource Fund. I'd like to welcome Graham from Pavilion, who is here to teach us about this investment option and why it may be a fit for your portfolio. With that, I'd like to turn it over to Graham to get started.
And thank you, Corey. I'm Graham Keeler with Excellent Capital Management, and we're a boutique private equity firm based in Toronto. And I'm very excited to be here today and have the opportunity to introduce our signature Pavilion Resources Flow-Through Fund. Today, we'll look at how the fund works and who can benefit from this government-sponsored tax advantage program that's based on the Canadian resource industry. And this is an information session only, and you should not rely on the presentation to make an investment decision. And this is really what I like to refer to as a quick walk around the car. So please have a thorough look under the hood and work with your advisor for more in-depth information and to determine if the fund is a good fit for you. So Pavilion may offer potential for above average returns in the Canadian junior resource sector. And as part of the federal flow-through program, Pavilion provides for 100% or more, 115% or more over time in tax benefits for every dollar invested, which can help offset some of the associated risks, along with offering portfolio diversification and experienced professional management. And the timing may be great as well, as it seems that we've entered what's called a commodity super cycle worldwide, and these cycles can last for 10 years or more. And the current one is being driven mainly by government commitment to vehicle electrification, which in turn leads to more critical minerals needed for battery production. And at Excellent, we really believe that all great businesses and great investments should start with a why. Why do they do what they do? Only followed by what they do and how they do it. And Mr. Pembleton's why for starting Excellent Capital in 2002 was really to identify niche markets and design smarter and more effective investment products and make them accessible to the Canadian investing public. Our signature fund, Pavilion Resources Limited Partnership, was created in 2008 because Dan saw firsthand how the true pioneers in the industry were creating massive wealth. So he created a fund that could replicate their investment style, with the added significant benefit of tax deductions and credits for those who invest. Why would somebody consider an investment in Pavilion? Well, there's many reasons, but unlike RSPs and TFSAs, for example, flow-through doesn't have an upper limit on how much you can invest each year to help offset taxes otherwise owed. They can also be bought by corporations and trusts, not just individuals, and are a smart vehicle for high income earners or really anyone with a high tax burden from any source. For example, the sale of a building or a severance package. Also, withdrawals from the RSP are taxed as income, but all cash received back on a flow-through investment is taxed as capital gains, which is half tax. And as mentioned, we have very experienced institutional grade management who've successfully managed 18, I think now, distinct Pavilion funds to date. So who can benefit? Well, pretty much anybody in a high tax bracket and or experience a one-time larger tax burden can benefit from utilizing Pavilion to offset a significant portion of the taxes otherwise owed. An example of a one-time tax burden, as I mentioned previously, could be the sale of a large asset, such as a commercial or residential building. Some could benefit by using flow-through to effectively liquidate some funds from an RSP and convert the income taxes that would be owed from that liquidation into a future capital gain. You would want to speak with your advisor about how to do this properly and conservatively. The flow-through program is also very effective in diversifying your portfolio into the Canadian junior resources sector. So what qualities should an investor look for in a fund, in any fund, prior to putting up their hard-earned capital? Well, I've identified a minimum of 8 that you see here. So let's take a bit of a deeper dive into them. The company president and founder, Dan Pembleton, began his career in the financial industry as a floor trader on the Montreal Commodity Exchange. And from there, spent nearly a decade at Dominion Securities as VP of about a $3.5 billion global money market fund. And Dan's education includes an honors BA in economics, an MBA, and Chartered Financial Analyst designation. And Mr. Pembleton and Excellent Capital are registered with the Ontario Securities Commission and across Canada as portfolio manager, investment fund manager, and commodity trading manager. So very solid management. And of course, Dan's not alone, but surrounded by a few key players in the company, including researchers, analysts, project managers, and more. It's really a true team effort. So with Pavilion, we don't let the tail wag the dog, as I say, meaning that each year we create a unique fund with the intention of making absolute returns for investors' capital and not solely relying on the tax benefits alone. And the fund is typically made up of between 20 to 30 individual resource company stocks, mainly in the mining sector. And this pool of small and microcap stocks can provide for better return, better than market return over measured periods of time. And most, if not all, other flow-through funds in Canada have an 8 to 24-month operating window. Pavilion, on the other hand, has a maximum 60-month term, which offers, it really offers it the ability to hold on to shares during bear markets, as well as to give the underlying resource explorers and developers the time they need to hopefully turn a profit. And 8 to 24 months, we feel is not enough time for this. So this fundamentally sets Pavilion apart from the competition, and it's proven out to be a very, very successful strategy. So although no one should look at past returns as being any indicator of future potential, we at Pavilion are very pleased to have held, since inception, the #1 position in terms of unit values, more often than any other flow-through fund out there, whether private or publicly traded. And of our 18 funds to date, the lowest exit was $3.53. That was a total exit, and the highest was $23.68, with an average value of $13.80 per unit from a $10 starting point. So quite significant. Once the tax benefits are applied, and here I'm using an example with 50% marginal tax rate. So once that's applied, Pavilion's average over their funds is 133% across all funds. So again, quite good returns. So Pavilion does work on a performance fee basis, where the general partner and all investors share in any upside in unit prices, and it works as follows. The upfront unit cost is $10, as mentioned, and the first $11.20 in cash goes back to the investors. And any amount between $11.20 and $20 is split 80-20 in favor of investors, and anything over $20, which would be a double of the original cost, is split 60% to investors and 40% to the general partner. And this functions to keep the general partner's interests aligned with our investors. So when looking at any investment, a key factor to be considered is downside protection and risk mitigation. And the main risk mitigating tool in the case of flow-through funds is the 115% or more over time in tax credits for every dollar invested, which would act to reduce the at-risk amount an investor would have in the fund. Also, the majority of our investors utilize what we call the Pavilion ladder effect. In essence, it involves purchasing units in a new Pavilion fund each year consecutively for, say, 5 years. And by doing this, you're diversifying into multiple funds and multiple different resource companies. So stronger returns on some funds will obviously could negate weaker returns on another. And as you're receiving your tax credits each year, you're essentially using them in this scenario to offset the cost of next year's fund, and so on over the years. And for investors in the highest tax bracket, this could mean that the third year investment is effectively paid for by using the tax refunds from years 1 and 2. You're basically climbing the ladder each and every year at less and less out-of-pocket costs. So this is a tremendous wealth building strategy. And the eighth and final quality to look for in my scenario is in a fund scenario is consistent reporting. And with Pavilion, you receive what's called a T5013 tax slip for reporting purposes each year that the fund is active. So you get it not only after the year after you invest, but every year that the fund is active, you'll receive a T5013 tax slip for reporting on your taxes. There are also mid-year financial statements sent out and annual audited financials as well sent to all investors, as well as quarterly net asset value updates and portfolio manager commentaries. So specifically, how does flow-through actually work? Well, to help fund their exploration activities, Canadian resource companies will sometimes issue flow-through shares from Treasury to raise the capital needed for the exploration. And these shares are identical to the common shares of the company, but they do come with the added benefit of tax deductions for the purchaser. So investors purchase units in the Pavilion Limited Partnership, which in turn uses the funds to buy flow-through shares of many different companies, mainly in the mining sector. But because these companies do not need all the tax deductions available to them at this stage, they're not profitable, they simply flow through the deductions, which are called Canadian Exploration Expenses, or CEE credits. They flow those back to the Pavilion Limited Partnership, which flows them all to the investors who can use them to offset taxes otherwise owed. That's why it's called flow-through. The CEE credit reduces the investor's income by 100% of the amount invested, thus reducing taxes owed. So, however, in addition to the CEE credit, the main credit of 100% of the amount invested, there's also a second benefit known as the Mineral Exploration Tax Credit, or METC, that the federal government put in place in the year 2000. This is an additional 15% federal investment tax credit available on mining flow-through shares. And in the industry, it's known as the super flow-through, giving a total tax benefit of 115% over time. So the graphic on the right simply shows the client and fund process with a little bit more information now. So again, investors purchase units in the Pavilion Flow-Through Limited Partnership. They receive the tax credits and hold the units for a maximum, in our case, of 60 months. There is no liquidity during this hold period, and it's at the discretion of the fund manager when the shares are sold. Our history, however, shows that over the hold period, some monies will be sent back to investors in most years that the fund is active, as some shares are typically sold throughout the term. For example, in 2021, last year, we sent 3 separate cash distributions on all of the past year's active funds. At some point, a final exit and cash distribution happens when the remaining shares are sold and the cash is sent back. So of note, and this is quite critical, all monies received back from a flow-through fund are taxed as capital gains. This is what we call the transformative nature of flow-through investing. The tax deductions are used to offset income taxes at your highest rate, but all returns or taxed as capital gains are half taxed. You're effectively then converting income taxes payable today into a future capital gain. I'm going to repeat that because it's quite important. With flow-through on the tax side, you're effectively converting income taxes payable today at your highest rate into a future capital gain. And another major feature of flow-through investing is that you and your accountant can determine when to best use the various credits. You can use some, all, or none of them in any given year, and they can be carried forward for up to 20 years. And so this is a superior tax planning tool, very beneficial. So here we have an example to show the tax benefits at work, and this is a simplified example. In this scenario, an investor has taxable income of $200,000 and decides to invest $20,000 in Pavilion. The approximate tax savings will be around $11,000 with both credits involved, leaving just over $8,000 of the original capital at risk due to the tax refund. If the fund, in this case, only returned the original $20,000, it would leave an after-tax return of 90% in just 5 years or less, because these funds can exit sooner than the 5 years. That's the maximum. So even if a fund is flat at exit, there is still attractive returns possible just from the tax benefits alone. Flow-through funds do come with risks and can in fact drop in value over time, which is one of the reasons we firmly believe in using the laddering effect I spoke previously of, where you purchase a little bit over a set number of years. and purchase really a new fund every year for say 2, 3, 4, 5 years to smooth it out. So an investment in Pavilion Flow-Through can also be very beneficial in cases where an investor has a large one-time capital gain. And I spoke about the potential for that being, say, a large severance package or the sale of a commercial building, for example. And since 50% of the capital gains is taxed as income at the highest rate, the use of Pavilion to offset this can work very, very well. In this example, on the screen, there's a $1 million capital gain for this client, of which $500,000 will be taxed as income for an approximate tax bill of $270,000. If the client, however, purchased $435,000 Pavilion, they could use this amount to reduce income, thus reducing taxes otherwise owed. When the METC, that second credit I spoke of for 15%, is also calculated into the equation, the total taxes payable would equal zero, giving a $270,000 tax savings effectively. And combined with the time value of money, as well as the ability to continuously reinvest the tax benefits in Flow-Through until you're in a lower tax bracket, you can see how Flow-Through offers great tax benefits. So to wrap up the information here, Pavilion is essentially a tax-advantaged entry point for a diverse portfolio of resource investments designed to provide a return on the invested capital and highlights excellent capital strengths and vast experience in commodities. Canada is one of the higher taxed countries, as we all know, in the world, and we're now paying as much as close to 54% at the highest marginal tax rate in some provinces on income. And the fact is, they may increase that yet. That may be in the horizon. So it's in each of our best interests to find as many legal and compliant methods as possible to reduce our tax burden for ourselves and our families. So with that, I thank you for allowing me again, Corey, to go through a kind of a quick walk around the car, as I called it.
Thank you very much for joining us. That was a great presentation. And if anybody has any questions, please reach out to your Braintree Private Wealth Advisor. They can answer questions about this fund and also advise you as to whether or not they think this is a fit for your portfolio and potentially a suitable investment. So thank you very much for joining us today, and I hope you enjoyed the presentation.
Thanks.